So today what we're going to cover, a few different topics. We're going to cover what we saw again last year, what occurred in 2023, which ended up being a very nice rebound, thankfully, from what was a horrible year in 2022. We're going to talk about some key events and trends that we see coming in 2024. And then again, overall, just an outlook on the markets in general. It's going to be a probably nothing short of a crazy year again. We have the election coming up and all sorts of stuff geopolitically going on. So I think, yeah, we should hop right in here. First, we're going to look back on 2023 and the freshness of 2022 is certainly still upon all of us, I'm sure. Although last year it did feel great to have a wonderful rebound. 2022 was just it was a pretty incredible year for many reasons. Starting out the year in 2023, we were still technically in a bear market. We're going to talk a little bit about the interest rate hikes, one of the fastest hiking cycles ever taken place by the Fed. Some people have criticized it. Looking back right now, in hindsight being 2020, it looks like they might not have done such a bad job because I feel like it could have gotten a lot worse for sure. So I'm sure we all remember many calls for recession. That was the the overarching theme going into 2023. Analysts all over, economists all over. And we're not going to toot our horn here, but I think we kind of were in that camp that we might have already been in one. And for all we know, we could still be in one. More of a rolling recession, not necessarily just a strict definition recession where you have two back-to-back quarters of shrinking GDP, but more so a scenario where you're experiencing different sectors get hit at different times. We had a little bit of a downdraft during summer of last year, and then a little bit of a more intense downdraft in October, where I think that was, we kind of went through another correction and have really lifted off since. Just to give you some quick stats, the Dow Jones achieved a rate of return of 13.7% on the year. The NASDAQ gained 43.42%, and the S&P gained 24.23%. Certainly not too shabby. The Magnificent Seven is comprised of Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, which is Facebook, and Tesla. So again, we saw pretty incredible rallies within each of those last year. You can see the rate of return next to them ranging anywhere from Apple with in excess of 48% on the year up to the highest being NVIDIA at 238% on the year. Federal Reserve officials raised interest rates 11 of their 12 policy meetings, again, very rapidly, between March of 2022 and July of 2023. They raised the Fed benchmark interest rate up to 5.25% to 5.5% as a result of the first half of the year. So bond prices decreased because as interest rates move higher, the price of a bond theoretically becomes less valuable, and so you'll see the bonds move down. Ultimately, we do think yields are going to continue to come down a little bit at a time. The Taylor equation is something that the Fed uses to guide their rate hikes or rate declines, which is a combination of inflation as well as job growth or decline. And using the Taylor equation, that looks like we should be somewhere around the 4.5% range, if not maybe a little lower. So we do think rates will come down. The Fed might actually even cut in their upcoming meeting in March. We don't know. It's the market, as far as rates are concerned, is kind of alluding to that. But again, I do think rates should theoretically be a little lower from where they are today.
2024 has some key events that you want to keep your eye on and pay attention to for the coming year. The first is the Federal Reserve, their upcoming meeting with signals of potential rate cuts, which we should see and get some updates tomorrow and Wednesday. The continued geopolitical tensions with ongoing wars in Ukraine and the Middle East. Data releases on economic activity and inflation trends lower, and if inflation trends lower. And what everyone else is thinking, the presidential election year. The geopolitical tensions, I'm sure you've all been following when it first started off with Ukraine and Russia, then Israel and Palestine. That's what we saw when we saw that dip from last year, late summer, early fall, you saw a little bit of choppiness. That was the beginning of that war. So just to keep an eye on what's going on globally is important for the market in general. They're looking for signs that inflation is going to continue to ease. And for this economic data, we'll have to point towards continued slowing of the economy. And the key factors are jobless claims, the CPI data, consumer price index, what's going on with the housing market, is wage growth slowing down, are the cost of goods coming down, and overall, what is the unemployment rate? So it's key to follow those and make sure that everything is going according to plan. And being that it is a presidential election year, a lot of people tend to, get a little uneasy. But as a reference, for each election year, these are the returns dating back to 1960 of the S&P 500. All but two had positive returns, besides 2000 and 2008. 2000 was during that dot-com bubble burst, and 2008 was the global financial crisis.
Earnings strength is continuing throughout 2024. We are in the thick of earnings season. In fact, I believe it's over 40% of S&P 500 companies and NASDAQ companies are reporting this week alone. We've seen some great numbers to start off. Ultimately, acceleration in technological efficiencies, I think, is majorly important. You keep hearing everybody talk about artificial intelligence, AI, and is it good, is it bad? Ultimately, I think it is a major deflationary force. I don't know that any of us regular people have a full grasp on how it might be able to help us yet, or how to use it other than doing some cool stuff. But I do think it's going to become majorly relevant. Certainly, an election year is heated, and then you couple that with what's going on abroad, and people are feeling uneasy, and it's ultimately the times when people are feeling uneasy that you see some of the gains made. It's a bull market climbs a wall of worry, quote unquote. And so just have to make sure that we hang in there, make sure that the companies that we own are doing what they're supposed to be doing, and I think overall we will be okay.